Good afternoon. It's a welcome to have the opportunity to speak to your 48th annual conference. I was especially impressed by the video at the start. Quite the history there. It's an interesting, whoever had the job to select those captions. So I was especially glad to speak to this audience, given that we're so focused in Europe on developing capital markets union, which the Minister spoke about and which the central banking community strongly supports. An enhanced role for market-based finance has the potential to foster greater risk diversification while also enhancing financial stability by limiting the fallout from banking crises. As a mechanism for individuals and institutions to obtain access to a diversified pool of financial assets, and as a key investor base for corporates and sovereigns seeking to obtain market-based funding, the investment funds sector plays an especially important role. And in what follows, I focus on the role of investment funds in the intermediation of international financial flows. Of course, this sector is extremely diverse. We can categorize investment funds in terms of equity versus debt, leveraged versus long only, the level and sources of liquidity, ease of redemption, active management versus passive, geographic scope, maturity horizon, the use of derivative products for funding and asset allocation, the sources of funding, retail funders, asset-backed securitizations, and ownership structure, so whether mutual funds, special purpose vehicles, hedge funds. Now, in terms of thinking about international financial flows, the facilitation of equity-type investments is critically important in view of the risks associated with excessive debt funding. At the same time, market-based debt funding provides an important alternative to bank-based funding, with multiple funding channels a key element in the design of a resilient financial system. It's also important to recognise the interconnections between market-based and bank-based funding, since the banking sector itself depends on financial markets to raise equity and different grades of bond funding, while also relying on securitizations to release tranches of performing and non-performing loans from its balance sheet. In addition, a banking group may well include various financial entities that play central roles in the operation of securities markets. Historically, the investment fund sector has been more lightly regulated than the banking sector. Of course, the basic reason is for banks the importance of protecting retail depositors in view of the deposit-based funding structure of banks and the inherent maturity mismatch between short-term deposit liabilities and long-term illiquid assets such as loans to corporates and households. That said, the scale of the non-bank financial sector and the scope for bank-like maturity and liquidity mismatches between the liabilities and assets of some types of investment funds has given rise to increased scrutiny by regulators in recent years. Non-bank financing amounts to around $80 trillion at a global level, and given the growing size of this sector, agencies such as the Financial Stability Board has been working to understand this sector and frame policies to ensure the management of financial stability risks from these funding sources. Potential risks can take many forms. There are three main factors. One is the fragility caused by leverage. Two is a range of liquidity risks related to the possibility that the redemptions of more liquid or shorter-term liabilities may lead to defaults or forced asset sales that dislocate secondary markets. And third, we also have to keep an eye on the interlinkages with other sectors, whether it's vis-à-vis the banking sector, vis-à-vis insurance companies and pension funds, vis-à-vis non-financial corporates, typically arising from credit exposures. So it should be no surprise that there's an enhanced regulatory interest. Now, the question is what type of regulatory interventions may make sense, and it's fair to say there's been quite a challenging debate on this topic. Now, at one level, a symmetric, simple view would be all lending activity should be subject to similar regulation. However, really, regulation should be targeted with the specific risks associated with particular activities. So regulation should be proportional to the impact of failure and the probability that such a failure might crystallize. So regulators need to have a solid understanding of the business models of individual sectors and categories, and also to analyze the detailed data on the assets and liabilities of the financial entities supporting these activities. So, for example, a closed-end investment vehicle has a very different risk profile to a retail bank. Equally, an open-ended investment vehicle holding highly rated sovereigns has a very different risk profile to a retail bank. And even though a failure to meet redemption requests may have damaging consequences for a given asset manager or fund, it's not the same type of default event that arises when a retail bank closes its door to deposits, deposit withdrawals. Let me highlight one other important difference between market-based and bank-based funding that poses challenges to regulators. Typically, bank loans are originated and held until maturity on the balance sheet of banks. In contrast, the assets of market-based financing vehicles are often tradable on secondary markets. So the greater the liquidity of these markets, the less there's a problem in terms of any mismatches between assets and liabilities of these vehicles. This all depends on the liquidity of secondary markets, not during normal times, but in times of stress. So assessing the liquidity of secondary markets during stressed episodes is a big concern for regulators. It's also the case, particular types of special purpose vehicles and financial vehicle corporations may well be holding assets that are not particularly liquid, and that needs to be taken into account. So the challenge for policymakers at a global level is to develop a proportionate regulatory framework that suitably differentiates across this diverse range of investment vehicles, especially in relation to the liquidity of secondary markets. It's also important to take into account the potential for indirect contagion, by which adverse shocks can adversely affect a broad range of financial firms and markets through a variety of externality-generating mechanisms, such as fire sales, liquidity spirals, and information spillovers. So, in other words, the potential for indirect contagion may warrant a macroprudential policy framework for non-bank funding activities that varies regulations for liquidity, for margins and haircuts over the financial cycle. So having a macro view that may adjust these regulations in line with the scale of the global financial cycle. And it may also provide a role for policy authorities in disclosing aggregated information during stressed episodes. Now, beyond policy formation, financial authorities, including the Central Bank of Ireland, are heavily engaged in supervision, both at a domestic and international level. Now, the heavy cross-border nature of many investment funds means that this requires extensive collaboration across national authorities, which requires extensive dialogue, extensive data sharing, and so on. And the Central Bank of Ireland, in various international fora, are pressing for greater supervisory convergence in the measurement of risks associated with market-based financial intermediation. Let me turn to the Irish non-bank financial sector, just to give you a flavour of the nature of activities here. So I'm not sure if we have some figures loaded, but if they're not here on the screen, you can download the speech and the figures from the Central Bank's website. Good, so you can see figure 1 there, which is really screaming out at you, and these are billions, and a reference point here is Irish GDP in 2015 was just a nudge over 200 billion. So when you see numbers here, which are multiples of 200 billion, you can see how big the funds industry is here. So whether it's investment funds, financial vehicles, and so on, this is a really large international financial centre for these activities. So if we turn to figure 2, what you see is we're disproportionately large in terms of the overall level of euro area activity in these sectors. Let me particularly point out the money market funds and the hedge funds in terms of the amount of activity accounted for by Irish resident entities. So let's move to figure 3. And what you see here is in terms of the geographic mix, it's important to emphasize it's not particularly euro area focused. What you see here is the positive numbers are the geographic allocation of assets. The negative numbers below the zero line are the geographic sources of liabilities. And if you look to the right of the figure, you see the heavy reliance on the UK as a source of funding, and in fact the US both as a source of funding and as a destination. So Ireland is very much a part of the global financial intermediation. And what that means from a macro point of view, that traditional interpretations of the balance of payments are not very helpful, because we know that the patterns of ultimate ownership are quite different to the residency patterns captured here. So put differently, the geography of risk matters. Just because Ireland is a major financial centre for intermediation does not mean too much of this risk resides here in Ireland. Now, having said that, what that means is that we have to be very involved at a global level in assessing the interconnections between the possible shocks to Irish resident investment vehicles and shocks elsewhere. So not only do we have to care about possible links to the domestic financial system, but also to help the global effort in understanding the links between these funds and actors elsewhere. So if you turn to figure 4, this again to re-emphasize the global nature of activity, the figure 4 shows how important dollar and sterling funds are in the money market fund sector here. Even though, again, we're part of the euro area, it's not particularly focused on euro-denominated funds. So, we use the data, and we've been a leader in collecting data on various types of investment funds, not just to inform policy discussions, but it's also helpful for supervisory purposes, because by studying the granular data, we can identify, particular types of funds we may want to exert supervisory energy on. So recently we've extended the reporting requirements for financial vehicle corporations to all Irish special purpose vehicles, and also studying the links between the entities here and the domicile of the consolidating entity, if any, and the country of the sponsoring entity. So let me turn to figure 5. So this is where a fund a special purpose vehicle is consolidated into some parent group. Now, 43% are not consolidated, they're standalone. But where they are consolidated, you see concentration in some other countries which are also part of global financial intermediation, such as the Netherlands, some small international financial centres. When Ireland takes a chunk of that, in part that is local, but in part the consolidating entity might be an Irish resident entity, but in turn have a foreign owner. Let me turn to figure 6. And this is where the sponsor is identified. And again, you see here the importance of the UK and US, amongst others, as sponsors of these vehicles. I should also mention, by the way, that the Central Bank, our work programme in this area is also to analyse the risks of investment funds under stressed scenarios. So to this end, as I mentioned earlier on, we have to look at various measures of leverage, liquidity and interconnectedness. And we are doing it, but we would expect the asset managers of these funds also to be able to self-analyse their funds according to those criteria. So let me finish. So, I think the world of European policymakers, the world of central bank regulators would, really desire to see vibrant capital markets, which are essential for a well-developed and stable financial system, offering important benefits both for savers and for firms and governments that seek market-based funding. At the same time, there are clearly risks to financial stability which do require appropriate management, including by central banks. And to this end, it needs a better understanding of the cross-border nature of the assets and liabilities of non-banks in order to understand how shocks might arise and how shocks might be transmitted across the system. So this requires effective cooperation among regulators, and at the basis of everything is good data collection, and that is essential. So we welcome and we actively participate in exercises such as the shadow banking monitoring exercise of the Financial Stability Review, and we look forward, we encourage the FSB to expand the scope of the exercise to include all notable centres of market and non-bank financial activity. It's quite good coverage, but far from universal. And only by understanding the geography of risk can we properly assess the nature of the risks associated by market-based financing for different systems. So let me finish at that point. Thank you very much.